Welcome to the course, and welcome to this series of videos. In today's session, we're going to take a look at investment policy statements. Essentially, for anything to work, there has to be a plan. And for investments to work well, there has to be a plan that's going to recognize the needs of the client, the needs of the firm who you're representing, or the needs of a group of investors. And in this particular session, we'll take a look at several of the foundations of those investment policy statements or investment policy strategy. At the very beginning, I'd like to note that the material that's covered in this video is based on information that's included in the Global Investments text by Solnick and McLevy, one of our course texts. It's also based on the CFA curriculum that the textbook supports. And for that reason, a lot of the material, a lot of the slides are standard material that is included by the authors and still remains their copyright. The very first, or one of the very first things that I'd like to point out is that there is a very important foundation, a reason for having an investment policy statement and for having a clearly defined and well-articulated investment policy strategy. It's partly about legal and regulatory requirements. In most jurisdictions, in order to provide investment advice, you have to know your client. Sometimes you hear about the know your client or the KYC rules. Essentially, what you're doing is saying that in order to formulate an investment strategy, I had to understand certain things about the risk, return, and other qualifications of my investors. Also, to be able to identify investments that are going to be suitable for the risk-return profile for your client, you need to be able to communicate that with your client, and that's part of what the investment policy statement is about. Furthermore, there may be governance requirements that are required or mandated by local authorities and also by the stock exchanges and by the supervisory bodies that are both regulatory and industry-based. For all of these types of policy statements or policy strategies, there's some standard components that we would expect to see. Of course, there's an introduction that essentially says this is the purpose of this report. There's a statement of purpose for the strategy itself, statement of duties, for example, to report information, to communicate within a timely fashion, and so on, with named individuals. And that's going to be part of the statement of duties and responsibilities. Procedures for communication, for measuring, for quality assurance and due diligence are contained within the procedures part of the report. And then we get down to the real meat and potatoes. Things like the investment objectives. What is it that we're trying to do? Are we trying to produce a certain level of return? Perhaps 5%, perhaps 6%? Are we trying to meet a minimum target? Perhaps produce a return that's in excess of the Standard & Poor's 500 index? Are we trying to maintain the capital for future generations, perhaps? This will help us to produce investment guidelines, and those investment guidelines are going to also be based on the investment objectives. So how will the policy be executed? The use of leverage for investments, perhaps. Certain types of instruments that can be included or may not be included. For example, very low quality bonds may be prohibited. Perhaps there'll be other restrictions like tobacco or firearms. Perhaps carbon restrictions. The next stage is evaluation and review, taking a look at the way that the results will be provided back to the client in a timely fashion in a prescribed measure. And then there may be some appendices. So these can include things like the general asset allocation, 60% bonds, 30% stocks, 10% alternative investments, for example. There may also be rebalancing guidelines that say that we will review the portfolio on a particular basis and move back into those particular percentages on a regular basis. Those are typical type of appendices, but they're certainly not limited to that. We also have to have, probably more importantly than anything else, have a clear idea about our risk objectives. And there are two main types of risk objectives. The absolute, essentially saying 5% is going to be the maximum possible loss that we'll allow, or the percentage of our portfolio that is at risk within a certain period may be 95% of the original starting value. Or perhaps the value can't drop to more than a certain dollar value. That's an absolute measure because we can identify the number. A relative comparison is one where we take a look at another perhaps index or another standard. For example, we expect to produce a result within 1% or 2% of the Standard & Poor's 500 index, or the MSCI World Index, or some other particular standard measure. So those are some of the things that we use to define risk. Now, defining risk is part of the job. Understanding the risk is one of the most critical things that we do. And risk usually falls into two categories, and two different ways of looking at risk. Our ability to bear risk and our willingness to take risk. And those are clearly not the same thing. Willingness to take risk comes down to your personality. Do you believe that if your portfolio lost 5% or 10%, it would be the end of the world? Well, no matter what you tell your broker, clearly you are in a very highly risk-averse situation, and you do not want to take risk. You're not willing to take risk. However, you could be able to take risk, because if you were to perhaps lose that proportion of your portfolio, you could replace it from an ongoing income. If you have a regular income stream that could perhaps recover from a loss of 5% or 10% of the portfolio value, then it appears that you have an above average ability to take risk. In the end, it's not the ability that matters, it's the willingness, because clearly if you lose your client's money and they decide that it's your fault, then you're in a position of personal liability, at least to a certain level. And this all has to be measured and determined and agreed before anything gets started, because otherwise you would have you'd end up being sued by your clients, lose your license if you're a licensed representative, and be in big trouble. So risk tolerance is made up of both those things: the willingness to take risk and the ability to bear that risk. Some of the things that we do to measure the willingness to take risk: we have a discussion with our client. If the client says things like, investing is too difficult to understand, or I'm more comfortable keeping my money in a bank account than the stock market. If they tend to use the words risk and loss together all the time. You remember, risk is, by definition, a two-sided tool. On the upside, risk means we can make above average returns. On the downside, below average terms, or we could make losses. If they say things like making money on stocks and bonds is based on luck, safety is more important than returns, clearly if they agree strongly with all of these things, they tend to be very, very risk averse, unwilling to take any kind of risk. If they tend to disagree with all of these things, well, then they're much more willing to take risk. Different investment advisors have told me about their own special measures. One very successful investment advisor said that he likes to see what kind of car his clients drive up in. If they're driving a Porsche, or if they're riding a motorcycle, then clearly they are willing to take on a certain amount of risk, no matter what they say. If their client walks in the door and says, yes, I'm a wild and crazy risk taker, let's go wild, and you look out the window and see they drove up in a Volvo with an Auto Association sticker on the back, and that they're a super gold member in the Auto Association, I would take their actual statement with a little bit of salt. Some of the considerations on the other side when we're thinking about return: what kind of level of return are we looking for? For example, if your client comes in and says they have $1 million that they'd like to invest, and that they plan to retire, and that when they retire they expect to get $80,000 a year in income from their $1 million investment, that's about twice the realistic level. So in order to provide that high level of return, they would have to take an unbelievable amount of risk, and it's probably nothing that we could really deliver. Perhaps about 0.25% of the principal value is something that we could deliver. And so if you said, well, we can probably find $40,000 a year in income from from $1 million investment, then you're probably in more reasonable territory. In that particular instance, their return objectives are going to be absolute. They need this much money from that amount of investment. If you're working with a university and they have a foundation and that has $1 billion worth of capital, and they say that we require this much money to be able to fund things like scholarships, bursaries, endowed chairs for professors, an expansion of some of their facilities, and they've got a dollar value that they require, then that's going to also be an absolute level of return. If they say, on the other hand, that they expect to do as well as the stock market or to do as well as a bond market, perhaps, that's a relative measure of return. Are they taking into account inflation? And that's where we talk about nominal or real. If somebody says, I expect to make $40,000 a year in perpetuity, are they taking into account that $40,000 a year might not buy very much in 20 years' time? It might be might be enough money to pay for dinner at McDonald's in 20 years' time. So if they want to take into account the inflation, they're going to have to think about a reasonable measure of inflation and be able to effectively gross up their principal by that amount. And of course, for all of these, our return objectives have to be realistic. They have to make sense. We can take a look at the historical rate of return from certain classes of investments. 5 or 6% from equities, 3 or 4% from bonds, and see whether that meets the general expectations and, of course, the risk tolerance of our clients. There are a number of constraints on portfolio selection, and in no particular order, we could say that some of these include things like unique circumstances. It may be for religious reasons or perhaps for personal reasons. Certain kinds of investments are not acceptable. So that might be part of those unique circumstances. There may be legal and regulatory factors that bar certain types of investors from investing in certain kinds of investments. For example, if you're a pension fund, legally, you can only invest about 1% of your total assets in private equity. A lot of hedge funds are heavily invested in private equity, so that makes a lot of alternative investments out of the range of most foundations. So there may be factors that say you can't invest in certain things. There may also be good tax reasons for investing or not investing in certain kinds of products. Products which produce a high revenue stream or very high yield will have much higher tax obligation. So if you're a high earning individual and you have a high dividend yield portfolio, then you'll be paying far too much in taxes. On the other hand, if you're a pension fund with no direct tax liability, high yield investments might be the perfect thing for that particular type of investment, because some organizations like pension plans don't actually pay any taxes. The tax liability passes through to the pensioners. What's the time horizon? Are we going to put our money into an investment and leave it there for 5 years or 20 years or 5 weeks? That would also have a substantial effect. So do we have a single time horizon? Do we require our money in 1 year's time? Do we require a little bit of money in 1 year, but then 20 years from now when we retire, we'll get the rest, and perhaps 40 years from now, that we'd like to create a pool of wealth that can be passed on to our children or grandchildren. So do we have a simple or a complex time horizon? And what is that time horizon? Do we have any needs for immediate liquidity or a possible need for immediate liquidity? Yes, we're investing our $1 million, but we might need $100,000 in 2 years' time to pay for a particular medical procedure that is uncertain, but we'd like to make sure that money's there. Locking that money into long-term investments would clearly be a mistake. So liquidity is important. And in fact, in this next example, we see a really good example of why this works, or how this works. In this particular case, again from our textbook, you can see that this particular company, Sampo, is a general insurance company, not a life insurance company. They're in the general insurance business, property and casualty. They may have significant liabilities that pop up over time when there's perhaps a fire or a flood that affects many of their customers. So they want to make sure some of their cash is available in the short term. They can predict using actuaries how much they're going to need to be able to cover claims and some of their other expenses over time. But they can't know that with certainty. We don't know if this is going to be a big year for floods or thunderstorms or hurricanes or forest fires. And so actuarially, we know that yes, those things happen every 20 years or every 100 years, but it could be next year. And so we need to have available cash. You can see their portfolio is laid out. Their allocation of investments is the chart that's on the right. And in this particular chart, you can see that the largest single investment that they have is in bonds, in fixed incomes. They have some equities, about 9% in equities in their own region in Northern Europe. They have about 7% of other equities. They've got a little bit of private equity, about 1.6%. They've got some real estate and some hedge fund investments. The nice thing about bonds is that bonds may be, not always, but bonds may be more liquid. And in fact, if we take a look at the bonds in the portfolio information on the right, their fixed income investments are mostly highly liquid ones, things like government bonds. So the green pie shape, 31%, is European government bonds. They have Scandinavian government bonds as separate from that. Short-term fixed income also, they're going to be available on very short notice. U.S. government bonds. So there's a very liquid market for bonds. If we can't redeem them, we can usually sell them on short notice, and we can also use them as collateral to borrow money from other institutions in things called repurchase agreements. So in this instance, you can see that this is a company, this is an insurer who's got a possible need for a lot of cash very quickly, and as a result, they keep their money in investments that may be lower yielding, lower return than some things like equities, but they're going to be much safer. Time horizon is also going to be an important part of our consideration. We need to consider, as part of our selection process, the investor's time horizon or time horizons, because, as I mentioned before, there can be multiple stages between now and retirement, from retirement until the time that you perhaps go into an old folks' home, and then the final stage, creating an endowment for children, grandchildren, or perhaps donating money to charities, creating a trust. So that could be a 2-stage or a 3-stage process. You probably have a multi-stage process in front of you. You have from the time from today until the time you finish your degree, where you probably won't save much money. And then there's the time from when you graduate and you start working until the time you have a family, from the time you have a family to the time you retire, and then from retirement until you pass on. So those could be some of the stages or the phases in that process. During that period, there may be periodic need for liquidity to buy a house, put a down payment on that house, to pay for children's school expenses. And so you need to know that within those periods, there may be the need to draw down some of your investment capital for urgent needs or for planned needs. And then on top of this, there's the ability to replenish that pool of wealth. And of course, the best way to do that is by working. And so if you have a substantial amount of income in excess of your day-to-day living expenses, that increases your ability to take risks and increases the size of your portfolio in the long run. Tax concerns are going to be always important. One of the things is your tax status. Most of us have to pay taxes. So we have to worry about the marginal tax rate. If we receive dividend income, it's taxed at our highest rate, at the marginal tax rate, and so that would be a concern. If we have the opportunity to earn money from investments and take capital gains, and perhaps time the capital gains to periods during our life in which we have lower income, perhaps you take a year off of work to look after children, or a sabbatical year where you go and work from a beach, or perhaps just sit on a beach someplace nice and don't have a high income, you can sell stocks during that period. You have a low tax rate, and you can live off of the capital gains during that period at a low tax rate. So if that's going to be part of your approach, organizations have to deal with the same thing. I mentioned earlier we have organizations like life insurance companies and perhaps pension funds that are essentially tax exempt on their investments, because there's a flow through of the tax liability to the ultimate beneficiaries, to the pensioners or the people that are cashing in their life insurance policies. So that tax status might be part of it. There might also be legal and regulatory factors that are important as well. Governments may put restrictions on certain types of portfolios. Pension funds are probably the best example, because if a pension fund was to go broke, it is likely the government would at least partly bail them out. And so for that reason, pension funds are restricted from taking substantial risks by the government because of the type of moral hazard that's built into this. The fear that if the pension fund starts to believe that they will get bailed out, that they will take unusual risks, figuring if things go well, they'll make a fortune, and if things go badly, the government will bail me out anyway. Banks as well have got the same kind of moral hazard, and they have the same kind of regulatory restrictions. So some of the things then that are going to be part of that regulatory domain include restrictions on portfolio commission and use of non-public information, the use of insider information. Unique circumstances is a very broad category. It could include things that affect your particular ethical framework. So if your client comes in and says, I want to invest in companies, but I don't want to invest in oil companies, I don't want to invest in companies that make guns or weapons, that's going to be part of their ethical framework. And it's certainly within their interest or within their ability to say that. But of course, that may restrict or reduce the overall return to the portfolio. Saying that I'm not going to invest in companies that make up 20% of a stock market essentially reduces the overall set of investment opportunities. And if you remember the efficient market hypothesis and the efficient frontier, essentially it pulls in the efficient frontier just a little bit, reducing the overall set of investment opportunities. Similarly with religious beliefs, a large proportion of the world's population does not accept interest as a valuable way to make money. And so investments have to be structured in a way which will meet their investment requirements but not include interest. That's sometimes done by providing dividend returns through specialized types of delivery vehicles. So I'm thinking here in particular of Sharia compliant bonds that do not pay interest, but they provide a substantial capital gain. So like a zero coupon bond, they essentially meet those religious requirements. And there certainly will also be certain personal preferences. An interest to participate, for example, in ethical industries, in perhaps solar products, in new technologies. Those may be part of the investor's interest. And of course, investors have to be made aware that there may be a cost to restricting their investment choices. But it is still going to be part of their preference, and still certainly their right to specify. So now that we've thought a little bit about the things that are going to go into a portfolio and some of our concerns, we should take a look at how portfolios are constructed. We start off with our strategy. Strategy is articulated in the investment policy statement. In the case of the CFA organization, they have a general set of guidelines on how this should be done. They have their GIPS standard, which essentially says these are the things that we believe should go into an investment policy statement. Once we've discussed the types of investments, we need to take a look at the likelihood of achieving those goals. And part of this is to take a look at the historical pattern of our capital market expectations. We'll go into more detail on this in a minute. But essentially, what is the average return been to North American equities, to European equities, to emerging market equities, to bonds, to alternative investments like venture capital or private equity. And so we can take a look at those things. Next, we have to think about how we're going to allocate our investments among these different categories, taking into account things like the risk and return, and also especially the correlation between the different types of investments. Again, something I'll come back to in just a minute. And then we have the short-term portfolio. Strategic is long-term, tactical is short-term. So tactical asset allocation essentially says that in the short term, these are the areas in which we're going to invest. And we'll boil this right down to which stocks, which bonds should we be investing in, which individual securities. Coming back to capital market expectations, the second on our list after the IPS. What do we expect to see from a market return? We can take a look at the historical average of returns, and we'll spend a bit of time looking specifically at those market expectations. It's one of the first things that you should do when you're putting together your stock track portfolio is think about the type of return you expect to see from the stocks and the bonds for the different markets that you're looking at. We can see that there are certain indexes or indices that provide that information. We have Standard & Poor's indexes for Canada, for the United States. We've got MSCI indices that cover most world markets. We have bond market indices and so on, and we'll be talking about those in the next set of videos. Then we have the uncertainty that underlies all of those expectations with the different standard deviation for each class of investment. An important factor, something we'll come back to in just a moment, is the correlation between asset classes. To provide a really well-diversified portfolio, we want to choose classes of assets or types of assets that are different from each other. So if they have the same type of risk profile and the risk operates in the same way, we'd have very high correlation and very poor portfolio effect. So we'll take a look at that in a little more detail in just a minute. Then we have to think about the strategic asset allocation. What are the different things we can put our money into? Obviously, we start off with cash. Now, by cash, we could mean cash, but we could also be talking about government securities which have near cash attributes, things like treasury bills and treasury bonds, money market securities for very safe corporates that can be turned into cash quickly. And so, essentially, cash could be part of every portfolio. Of course, with a low return, but with very high liquidity. There are certain characteristics that are going to be important there. Equities provide us with a high rate of return, but possibly much more volatility. We have bonds, which are going to probably be safer in certain markets, but underperform in other markets. Real estate is a very good hedge against inflation, but suffers from certain problems like the cost of keeping the real estate and also high carrying costs. And then we have alternative investments, which may also include real estate, but include venture capital investments, perhaps hedge funds, commodities, certain types of specialized investments. So looking at the general pool of all of the different types of investments, we come up with these major headings. They do tend to change. Sometimes an asset will migrate from one category to another, but it does give us a general idea of how these things work. How do we define an asset class? Well, our purpose in defining an asset class is essentially to spot difference. If everything is the same, then there's really no benefit from understanding that asset class. If you take, for example, the world of bonds. Within bonds, we have got a couple of different major classifications. Now, those two classifications would be government and corporate bonds. So if we invest in government bonds, we know that there's going to be a much less likely risk of default. Governments typically don't default on their debts, especially if they're capable of issuing bonds in their own currency, which actually is important because most major economies like Canada can issue bonds in their own currency, so we don't have to worry about default risk. We do have to worry about inflation. And within a domestic market, we've got not just federal government, but we may have state governments, even municipal governments, and government-sponsored institutions, including universities, who may issue debt. So we have got a number of different possible classes within the domestic area. Foreign government debt, of course, may come with currency risks and perhaps, certainly their own inflation risks. And in the case of governments which issue bonds in other currencies other than their own market currency, there can be a certain amount of default risk. So even within each of these categories, we have several other possible subcategories of assets. Corporate bonds, well, we have two standard categories of corporate bonds. We have the triple B rated and above investment grade, and the double B and below high yield bonds. And so there may also be some more subdivisions within those, according to the maturity, liquidity, and some of the special characteristics that we've discussed in the bond areas. So an asset class, if you say bonds are an asset, that could be a simplification that we can't support. So are all of these specifications necessary? If we end up with 20 different types of bonds, we have too much specificity. We can't really use the extra information. What we try to do by defining these different classes is to see whether or not there are important themes. And the most important theme that we see in asset classes is whether or not certain classes are correlated. We're really not providing any diversification if we invest in 5 different asset classes and they all have the same kind of risk. So, for example, in this case, we have got several different types of equity investments, several different types of other investments, including things like commodities, real estate, gold, and different kinds of bonds as well. The first 1, 2, 3, 4, 5 of these are equities, and they're equities that are listed and are tracked by Morgan Stanley's composite indices for Europe, emerging markets, world, Europe, Asia, and the Far East, EAFE, and the US. Now, when you look at these indices, you see that many of the stocks that are listed in one index are also listed in another. So under the US index, a lot of the companies that are in the world index are also in the US index. US has got the largest capital market, and EAFE is basically everything except the United States. Emerging markets is very different from the world index because emerging markets are a small part of the total capitalization. So if we look in the top right hand corner, and in this matrix you'd see that the A and the A are the same. So if you're MSCI Europe, you have a perfect correlation because you're comparing yourself to yourself. If you're comparing MSCI Europe to MSCI Emerging Markets, there's a 0.77 correlation coefficient, which is certainly less than perfect. It's relatively low considering they're all equities. If you compare Europe to world, then in other words A to C, 0.95, there's a very high correlation, and that's because we have many of the same stocks that are in Europe are also part of the world index. If you have a high correlation coefficient, there's very little benefit to diversifying by trying to hold many different types of investments. So say, I don't really need to hold Europe and world or EAFE portfolios. Perhaps I'll have a Europe and I'll have part of my portfolio in emerging market equities and maybe a little bit in US, but I won't hold on to some of those other categories. High correlation means low diversification value. Now, if you look down this list, you'll see that some of these other investments do have much higher levels of diversification. Compared to MSCI Europe, commodities have a very low correlation. Gold has an inverse correlation, so that's a good diversifier. US Treasuries, European government bonds, those are all ones with very, very good diversification value. So if I was a European investor and I had a already had a portfolio that included European equities, I would look for diversification by finding things with low correlation or negative correlation coefficients. So generally speaking, there's very little value to adding to your portfolio asset classes that don't provide diversification value. You just have to do a little bit more work to control the investments, and they don't really add very much to the mix. When we're thinking about building an actual portfolio, and that's what you have to do over the next few weeks, your portfolio needs to consider strategic asset allocation. Which classes of assets are you going to be interested in investing in? Within that, you need to look at the tactical asset allocation. We'll look at that next. And then specific security selection. And I'll give you an important hint. The most important thing on this list is not picking stocks. Not picking the best stocks, not picking the best bonds. Because a well-balanced portfolio is already going to provide the diversification that makes a lot of that irrelevant. We'll come back to that one in just a minute. The overall process says that we want to find a certain minimum or maximum level of risk for our portfolio. And that is going to be an overarching principle that's going to affect the asset allocation, the tactical allocation, and security selection. Now, for the we've already looked a little bit at the strategic allocation, but for the tactical allocation, we need to next think about some of the factors that are going to drive risk. Are they going to be risk factors that are going to affect entire markets, or are they going to be factors that affect the individual security or perhaps a subsector of the market? Things like oil prices at a certain level are non-systematic, or they're idiosyncratic, firm-specific. Quality of management, exposure to a certain market or a certain technology is another non-systematic risk factor. Things that affect everybody, including things like interest rates, exchange rates, at a certain level political risk, things like that are going to be considered to be systematic. They affect everybody. Then if we're looking at our overall approach to the market, the other side of the matrix, are we going to have some kind of an overall market average rate of return, either using some kind of passive investing or tracking an index, or are we going to be trading on information and trying to produce alpha, produce some kind of excess return through active investing by moving our money from one area to another? If your focus is systematic and market return, then clearly your approach is going to be to follow a strategic asset allocation with very little maneuvering on the margin that we describe as our tactical asset allocation. If you believe you can use information and a superior ability to judge the markets, then you can look for tactical asset allocation. In other words, in the short term, moving money a little bit heavier into one segment than another. If you think that this is going to be a really good year for emerging markets, increasing your allocation to emerging markets and perhaps going for major companies that are heavily invested in those emerging markets as well. That would be part of a tactical approach. And then next year, perhaps changing your tactical approach to favor the other sectors that you think are better suited. If you believe that you have an ability to pick stocks that is above average, then your focus is going to be entirely on security selection. You understand the idiosyncratic, the firm level or non-systematic risks, and you use your superior information about the market, you believe, to be able to pick those winning stocks. And that's where security selection comes in. Essentially, and of course this is something that we hear over and over again, the general belief is that people, investment managers, no matter how smart they are, no matter how well informed they are, do very poorly when it comes to picking winners. And so the idea that alpha is created by individuals systematically choosing winning stocks is one that statistically is something that we can't believe or we can't support. We say that the value added by security selection is generally wiped out or generally removed by the value lost by security selection. We picked that mining company and not that mining company, and turns out that the company that we chose was a loser, and the company that we didn't choose was a winner. Overall, the net effect of choosing stocks or picking stocks tends to, on average, be zero. For those of you who are familiar with the equities course that we just completed, essentially that's what Burton Malkiel was talking about when he described a random walk down Wall Street, that picking winners is something that statistically we just don't see in the real world. Now, another stage of our process is to manage the portfolio once we've created it, and we describe this as rebalancing. Rebalancing is one of the most counterintuitive things that we do. We've created the portfolio, we've said this is the way we're going to allocate our investments, and then once we've done that, we find that one area is doing much better than the others. That's wonderful. We're getting a much higher rate of return in this one class of asset than we are in these other ones. What should we do? Well, rebalancing policy, kind of counterintuitively, says we should sell the winners and buy more losers. Well, because we believe in the statistical properties of the markets, and we say that if this market is doing really well, or this segment is doing really well, statistically they'll probably do worse in the next period. We have too much investment in the stronger part of our portfolio because it's done really well, and we should bring that back down to a more normal level. It doesn't make sense, does it? A friend of mine lives in Calgary, and in Calgary people talk about the oil industry all the time. When he was planning for his retirement, he continually invested, and because most of the talk was about oil investments, he put his money into the oil industry and a couple of other investments, but most of his focus was on oil. Every year the oil industry did really well, and so he continued to reinvest in the oil industry. By the time he got to retirement, the oil industry had collapsed, and most of his investment was in one segment. Now, a more reasonable approach would have been to take the earnings that he gained from the oil segment and invest it in other areas, perhaps mining, perhaps banking, commercial businesses, consumer products, and have a well-rounded portfolio. And then when the oil market crashed, all of his money wouldn't have been in oil. We say that he was overweight in that one segment because that segment had continued to grow over time, that a more rational approach would have been to look at the overweight segment and transfer the money to other segments, building up the portfolio and maintaining some kind of a balance. So essentially it starts off by identifying what we think of as reasonable policy weights. We say we're going to be 30% in equities, 20% in bonds, 10% in alternative investments. Perhaps within our equities area, we're going to be 20% in United States, 20% in Canada, 60% in the rest of the world. Those are going to be decisions that we make based on the risk and return requirements of our clients. And that's how we set up our original policy. That's part of our strategic asset allocation. Of course, other things like cash need to be in there as well. Then we observe the returns to those asset classes and securities over time. So after a year, we have a high return in one segment, a lower return in another segment. And then once we've observed that, the next thing we do is identify deviation from policy. We planned on having 20% in this category. Because of growth, it's now up to 25%. And that's when we should start to think about, perhaps, rebalancing. We're going to sell some of our successful ones and buy more of our unsuccessful ones. It's counterintuitive. And in a way, that's one of the things that makes it really useful to know about, because sometimes our intuition is what gets us into trouble. Remember, people have natural biases. We make mistakes consistently because we don't recognize those biases. And this is one of those areas. We'll talk a little bit more about biases later in the course. Here's an example of strategic asset allocation for one particular client, a European charity. The asset class is given in the first column, so you can see we've got European and international equities, European government bonds, corporate bonds, cash and money market instruments. The original policy said we're going to have 30% of equities, or European equities, 15% international, 20% government bonds, 20% corporate bonds, and 15% cash and money market instruments, of course adding up to 100%. we've defined corridors, and these essentially are going to give us the upper and lower limits. So if 30% is our policy weight for European equities with a 2% corridor, it means we can allow our fund to go up to 32% and down to 28%. Anything above 32% would say we're overweight in European equities, and anything under 28% would say we're underweight. And for all of these other categories, we've also set 2% corridors. And so you can see how high or how low we can go without breaching those rebalancing rules. Now, after a year, our observation is that we've done really well in European equities. With a 15% rate of return, that is our real star category. But because we've done so well, as a result of the expansion, the growth of that part of our portfolio, we've gone from 30% in the previous year, where we were spot on, right on our target, to being overweight. We're 32.4%, and our rules say our upper limit is 32%. A reasonable rebalancing strategy would say we should be selling some of our European equities to get back down to 30%. And where should we put that money? It looks like our weaker categories are perhaps going to be in cash and money market a little bit with a very low rate of return. And also it looks like we're down especially in European government bonds. So reallocating some of our investment to some of our lighter categories. Now, of course, this is counterintuitive. You'd say you made a lot of money in European equities. Why don't you just increase your policy? Well, if you believed in the long term that was a good approach, you would revisit the strategic asset allocation and redefine the policy weight. But in general, we know that markets that go up can also go down, and if they tend to be more volatile, it might be a mistake to go overweight in a category just because we've had one good year. So this is an important part of the approach to our asset allocation, and that's a big part of our IPS. So in this session, we've taken a look at we've introduced the idea out of an investment policy, the strategy, and the statement. So we saw what some of the components of the statement are. We talked briefly about risk and return objectives, and we'll come back to that with examples as we go through the course. We looked at some of the things that define risk tolerance, the willingness and the ability to take risk. Some of the constraints, some of the things that say that we essentially should adjust our investments to certain categories because of certain important features. How do we balance our risks? Risk budgeting for the systematic and the idiosyncratic risks. We talked about the identification of asset classes and how those are going to help us to define our strategic asset allocation. And then we talked briefly about things like tactical asset allocation. Security selection is essentially going to be part of the process, but it's not going to be an important part of the first stage of the investment policy strategy. And we looked at the monitoring and rebalancing of our investment policies. This is a very brief introduction, and I hope you found it useful, and I look forward to talking to you a little bit more about this in our next video.